This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This chapter looks at the external influences on organizational performance. It will also cover a subject called customer profitability analysis, and very importantly, it will revise for you activity-based costing and activity-based management. But first of all, let's look at the potential external influences on an organization's performance. And the first thing we can say is, if you just think pastel, these are the large macro events which can affect performance, politics, economics, social changes, technological changes, environmental or ecological changes, and legal changes. And we've kind of covered those already. What we get on to next is just how government can be particularly involved in influencing performance. Governments, of course, are very powerful. Changes of law, taxation, economic policy, and so on have got profound ramifications in many organizations. And here's just a list of typical ones. Labour legislation. Governments can bring in new labour legislation, for example, minimum wage rates, maximum working weeks, health and safety legislation, and so on, in airlines and in many countries for commercial drivers. The number of hours that somebody can work without a rest period is also limited for safety reasons. Trade union legislation. In some countries, trade unions are relatively powerful. In others, their power has been curtailed somewhat, so that it becomes harder for them to call strikes without, for example, getting the approval of their members. Consumer protection legislation, both in terms of the health and safety aspects of consumer products, but also the consumer's right to, say, return a product and insist on having their money back if the product breaks down or doesn't work correctly. Exchange rates and taxation, pretty straightforward. This will profoundly influence how many organizations get on. Antitrust and monopolies, competition type policies. This can affect whether or not two organizations are allowed to merge, whether a takeover is given permission or not by the regulatory authorities. Business legislation comes in all over the place, setting out rules and regulations about reporting requirements, how companies maybe have to conduct business, maybe for how many years even they have to keep their financial statements, which puts a kind of an overhead on them, and so on. It can affect perhaps corporate governance. Some countries have got two-tier boards. You've got the main board, and then you have your non-executive directors as a second board. Other countries have got integrated boards with the non-executive directors sitting there. In America, there's the Sarbanes-Oxley Act, which puts quite onerous conditions on companies in the name of corporate governance. Social legislation such as welfare benefits. What are the entitlements of your employees if they're off sick or on maternity leave? What are their entitlements for job protection, and so on. Supply side policies. This is mainly to do with labour. How easy is it, for example, for you to make people redundant? If you can't make people redundant, then the problem is that firms are very often reluctant to employ people in case they don't need them. Supply side policies makes it easier to buy raw materials, import raw materials, perhaps train your own staff and so on to your own requirements. And increasingly there are green policies. The amount of rubbish and pollution which companies are allowed to produce is limited. It becomes increasingly expensive to get rid of waste materials. There's PR aspects as well. Large fines and regulatory events will occur if you break some of these green policies. Externalities is the name given to where there's a cost which let's say a company releases gases, or a company uses heavy lorries over the road, it's making use or affecting the environment, but does it pay the whole price for the use of its making of the road, or for perhaps for the extra cost which is incurred because of poisonous gases being released into the environment? And increasingly the movement is really that companies are being asked to try and make some sort of contribution for all the costs which they make use of some way or another. Michael Porter described 7 ways in which a government can affect what's called the structure of the industry. First of all, capacity expansion. Governments can encourage more suppliers to come into the market. They can give grants, for example, to encourage more businesses to set up. Alternatively, they can make it very difficult for new businesses to set up. They can protect the ones which are there by putting perhaps some sort of onerous licensing in regulations in place before somebody can set up. Demand, this is really government expenditure. If the government decides to spend more money, for example, on roads, this is going to affect many businesses in that sort of area. The government might put more money into health, which is going to affect the demand in pharmaceutical companies and so on. Roughly speaking, government expenditure in the West is about 40 to 50% of gross domestic products, depending what country you go to. So government spending has got a huge influence in overall demand for products. Divestment and exit. How easy does the government make it for companies to close down and get out of a business? If there were very high and onerous redundancy payments, this could keep businesses there, just making a tiny marginal kind of contribution, positive contribution, because that's actually cheaper than leaving. They might even be making a small loss, but this is cheaper than actually leaving the business and having to incur maybe large redundancy payments for their staff. Control of emerging industries. Again, government can encourage these, or sometimes government can protect them. Emerging industries are almost by definition going to be small, and large competing industries, perhaps those abroad and so on, could use their financial muscle to really kill off these newcomers at birth. And governments can offer protection of various sorts. The government could itself give them a contract, perhaps, to get them through the first 3 or 5 years. Government could have preferential sourcing. Governments could give perhaps tax breaks. Competition, we've kind of mentioned this already. To what extent does the government approve of competition, or does the government restrict competition? By and large, in many countries, the moves of governments have been to try to encourage competition and to move away from monopoly suppliers, particularly monopoly state suppliers. And new product adoption. For example, in pharmaceuticals, governments can regulate the types of tests and the safety procedures that new pharmaceuticals have to go through before they can be licensed. Similarly, cars. Cars have to go through a safety kind of set of safety tests before they can be sold. And governments can make it harder or easier for new products to come onto the market, depending on the sorts of tests and regulations which they stipulate. Now we have to look at fiscal and monetary policy very briefly. This is how governments control national economies. And the first one we've got here is fiscal policy. And this really comes from an old name, an old English or French name, which I think was fisc, which really means the king's purse. Now it's not so much the king as a state, but where does the government get money from, and where does it spend it, essentially? So there's government expenditure on infrastructure like roads and railways, education, defence, police, health, social payments and so on. Those are typical expenditures of government. And before government can spend the money, it has to get the money from somewhere. And it either gets it essentially from tax, or it gets it from borrowing. And these three really have to be kept in balance. If the government wants to spend more money and doesn't want to put up taxes, it'll have to borrow. If the government wants to spend less, then it can cut income tax, for example, or could pay back some of the borrowing. If the government wants to cut back borrowing, then, as many governments are doing at the moment, the financial crisis has shown that many governments' borrowings are very high, because then the government has to pay interest on the borrowings, which is very expensive. So many countries have been trying to cut what's called the deficit. The deficit is where the government has to borrow to bridge the gap between expenditure and income. And what many countries have done is they've tried to reduce expenditure. So many government salaries, any public workers, salaries have been frozen, in some cases even been cut. In some cases, there's a bit of an argument really, should we do it by putting down the amount of expenditure, or should we do it by maybe putting up the amount of income tax? Doesn't mean you have to put the rate up. Some economists argue if you stimulate the economy, so for example there'll be more sales tax, and that'll automatically give income to the government. But it's basically a balancing act between these three. If a government comes in and has a public a statement, if you like, in its manifesto that's going to cut borrowing, but it doesn't really want to put taxes up, then anyone who's selling to the government knows that the government is going to be spending less, and they're likely to be in for a bit of a harder time. The second approach is what's called monetary policy. This is control of the money supply. And really there are four ways of doing that. Interest rates. If interest rates are increased, the borrowing of money becomes more expensive. Fewer people borrow, and if you borrow less, you spend less. So typically what governments would do, if inflation was high, that's where there's a lot of money chasing goods and pushing the prices up, they would increase interest rates so that people borrow less and buy less. There is the money supply, which is basically the government printing money. The government can print its own money. This is sometimes nowadays called quantitative easing, and this allows more money simply to be issued into the economy. Reserve requirements and credit controls. This is really to do with banks. A reserve requirement is an indication of how much, if I put $1,000 in the bank, how much of that can the bank lend on? If it could only lend on $100 worth, then that's quite a tight money supply. But if the bank is allowed to lend on 900, then of course this in a way magnifies the amount of money which is in the economy. And then exchange rates. Changing the exchange rate is going to make your currency more or less popular, and this will affect the amount of money in the economy. So, fiscal and monetary policies are the two main levers that the government can use to try to control the economy. Now we're going to look at customer profitability analysis. This is a very simple concept. What you can't do is just look at your customers and say that one's got the highest revenue, that one is the most profitable. It might have the high revenue, but it might have very high costs associated with it, so that in fact the profits aren't great. And for some troublesome customers, you may discover that the amount of work involved does not cover, is too much for the revenue. You're actually making a loss, or certainly a loss at current selling prices, and then you may have to negotiate putting prices up. So this is the example found in Chapter 7, Example 1. And we have three customers here, and we see the gross profits here, and it looks as though perhaps customer B is really doing quite well. They're the highest margin. But then we have some data from ActivityBased Costing, which shows what other costs might be associated with them in addition to just the revenue less cost of sales, giving the gross margin. There are sales visits in there. Let me see if we can get this to right. There we are. There's some sales visits there. It takes some costs to process orders, dispatch costs, and the billing and so on. And it's really, really simple. All we have to do is to say, well, here is the gross margin before any of these costs, and then we have these costs to add on. And I'm just going to do it for customer A. You can, just for the sake of it, go and look at customer B and see if you can simply replicate my calculations. That's really, really easy. So we have orders placed, and here we have order processing is 190 per order in there. So presumably we're going to have in there 190 times 200 as costs associated, and I just do it in thousands here. So we're going to have 190 times 200. That's going to be 38,000. We have dispatch costs, which are 350 per order placed, so it must be in there 350 times 200, so it's going to be 70. Then we have sales visits. Each visit costs 80, so it's going to be 80 times 420. So 80 times 420. It's going to be 33.6 in thousands. And then we're going to have the number of invoices raised, billing and collections, 97 per invoice raised. So there it is going to be, it's going to be coming in at 97. And the number of invoices raised is 200. 97 times 200 is going to be 19.4. So the profitability of customer A, after all associated costs have been taken off, is going to be the 897 less 33.6 less 38 less 70 less 19.4. So we have 897 less 33.6 minus 38 minus 70 minus 19.4 is giving us the profitability of 736,000. If you are going to do the other ones, or by looking at the answer, you will see that B is going to come out with about 824.16. And the third one is going to be coming out at 551.3. So customer B is still the most profitable one, but instead of customer C coming next, it is customer A's. Customer C has got a lot of bother, lots of fairly small orders there for that revenue there, an awful lot of invoices raised, one for each of those orders and so on. Customer C is a bit troublesome. Quite a lot of revenue, but a lot to sustain that revenue, and not quite as good as perhaps they initially looked. Customer profitability analysis, there's every question is going to be kind of quite unique. You just have to read what the costs are and do your best at working out the cost per customer or the cost per customer order. Activity-based costing is a really, really important technique in this paper. Activity-based costing is going to give us more accurate costing of products, and once you know the costs more accurately, then you can presumably control those costs more accurately as well. Generally speaking, the easiest way probably to think about improving performance is to look for improvements, reductions in the biggest cost. So a 5% reduction in the bigger cost is going to create much more profit than a 5% reduction in the small costs. But the first thing to do is to understand the costs properly. And the steps in activity-based costing, first of all, you create cost pools. So what are all the costs, say, associated with quality control? What are all the costs associated with processing an order? What are all the costs associated with setting up a production line and so on? So you create these pools, these collection of costs, and they are then identified with what the normal terminology is a cost driver, but I much prefer to call it a cost causer. What activity causes costs? What activity causes quality control costs to increase, setup costs to increase, and so on? Find the cost then of each occurrence of the of the cost cause of the cost driver. So every time you inspect 100 items, what's that going to cost? Every time you set up the production line for a run, what is that going to cost? And then once you have the activity cost, or the cost per activity occurrence, you can work out, right, for that cost, how many units am I getting? That allows you to work out the cost per unit. What it does, it will move costs, it will transfer costs towards the more troublesome items, the items where you have to incur relatively high costs and you don't get very many items produced for all of that bother. So here is the example from chapter 7. This is the example 2. And the problem is these two products. So we have what you might call product A, these kind of ordinary product. Product B, a much lower volume. Here it's selling at a much higher price. 210 is a kind of luxury product, perhaps. The marginal cost is the material, the variable labor, the variable overhead. This never changes under activity-based costing. The only thing we move around are fixed production costs. Here we have the fixed costs, which have been absorbed on a normal basis, just effectively per unit, if you like, or per labor hour, or something of that sort. This will give us the total absorption cost, so the sum of these ones here, the total absorption cost. We then add on a 50% margin, and we end up with the two selling prices of 120 and 210. So investigation shows that 1/3 of the fixed costs relate to batch setup costs. So every time we stop the production line, rejig it, set up the machines to produce another batch, we incur substantial costs. 2/3 relates to time spent in the factory. That's just, if you like, the ordinary overhead type of absorption. Each unit of B takes twice as long to make as a unit of A. Product A is made of batches of 500, but product B is made in batches of only 100. So for really the setup cost, you are getting only 100 units of B, but you're getting 500 units of A. It's a much more efficient use of this batch setup costs. And it simply says that it wants us to recalculate the example using activity-based costing. And I should apologize, this I think is actually example 3 from the chapter 7. So, first of all, we would have to find out what the total overhead costs are. Then we'll divide them 1/3, 2/3. That's really saying that 1/3 of these costs relate to the setup cost pool. The other 2/3 of the costs relate to all the other stuff that's going on in the factory. So what will the total overhead costs have been? Well, if they're absorbing it correctly, it is saying that we are producing 1,000 units of A, and each is absorbing or accounting for $30. We're producing 200 units of product B, and each of those is absorbing or accounting for 60. So we've got 30,000 in there, plus we have another 12,000, so that's going to give us 42,000. So the total fixed costs were 42,000. And this is going to be split 1/3, 2/3. So it says 1/3 of these costs, which is going to be 14,000, is going to be to do with setup. And the other costs, which is going to be 28,000, is going to be dealing with simply other fixed costs which are caused or absorbed on a time basis. Okay, so we see the setup costs are 14,000, and these are caused by setups. So how many setup occasions are there? Well, here we have demand of 1,000, and it says each setup here, or each batch, is of 500. So to get 1,000 units of A, there must be 1,000 over 500 equals 2 setups. B, we end up with 200 of those produced, and they're produced in batches of 100, so there's going to be 2 of those as well. So all told, there are 4 setups. 4 times where we have to stop the production line, rejig it, and set it up. And these are causing these costs of 14,000, causing the setup costs of 14,000. So the cost per setup $3,500. So 4 setup occasions, each costing 3,500, is going to produce total setup costs for the period of 14,000. What do we get for our money? Well, that's very different. So for one lot of 3,500, one setup effort, what we're getting is 500 items of A being produced. So the setup cost per unit for product A here is going to be 3,500 over 500 is going to be equal to 7. For B, still for one setup cost of 3,500, we are, however, only getting 100 out of that, equals 35. So vastly different kind of efficiency, if you like, or cost caused when we make B products, because they're made in quite short, inefficient batches, than we make A products. So let's see how the new cost structure would look if we do it now on an activity-based costing kind of basis. So we have product A, product B. Remember, we said that the marginal costs are not changing this at all, so they were 50 and 80. But now, instead of lumping all of the fixed costs together and treating them all in the same way, we are treating each cost separately insofar as we can identify it. So we have some setup costs. And from the previous slide, we saw that the cost per unit of A was 7 and the cost per unit of B was 35. And we know that we are producing in here, the total number of units we're producing was 1,200 in it. So let's just put the units up here as well. So the number of units was 1,200. We might need that later. What about the other costs? The total other costs came to 28,000. And we're told that one of these products, each unit of B takes twice as long to make as a unit of A. So what we have to do is to kind of divide it. Just for the sake of argument, an easy way to see this is to say that A takes 1 hour and B takes 2 hours. It might be 5 minutes and 10 minutes. It might be 3 hours and 6 hours. It doesn't really matter. But that has put down the idea that 1 unit of B takes twice as long as 1 unit of A. So how many hours are we budgeting for if we were doing it like that? Well, we are saying, dividing that over the labour hours in here, we're saying there's 1,000 hours dedicated to product A, 1,000 units of 1 hour each. And we're saying each unit of B would take 2 hours. That's going to be 200. So we'd end up there with, if it was 1 hour and 2 hours, and that doesn't really matter, we just want to get the 1 to 2 ratio in here, it'd be 28,000 over 1,400. So the fixed overhead absorption rate per hour, on our pretend hours at any rate, there is going to be 28,000 divided by 1,400 is going to be 20. This would mean that the other costs here, we said that A takes 1 hour, so it'll have 20, and B will take 2 hours, so there's going to be basically 40. And this will absorb all of these 28,000 overheads, because we have 1,000 units at 20, that's 20,000. We have 200 units at 40, that's 8,000, and that comes back and will absorb that 28,000. So, marginal costs, these are our two elements of fixed costs here. This will give us the total absorption cost. So it's going to be 77,000. This is going to be 155,000. And then we have the markup, the 50% markup. We keep applying that. So that's going to be 38.5. And the other one, divide this by 2, is going to be 7.5. And I think 7, yeah. So we're going to end up here with costs of 5, 5, and 1. So it's a selling price rather. And over here, that should be 0.5. It's going to be 5, 12, 13, 1, 2. Remember the previous costs and selling prices, the previous selling prices which we had for these two products, 120 and 210. So this is the way we've moved. We've effectively said that product A is made quite efficiently, and we have reduced the selling price from 120 to 115.5, or reduced potential selling price there. Whereas product B, we're really saying we have to increase the selling price if we're going to account properly for the troublesome nature of product B. And really, when you're making products, you do want, if possible, to get a selling price and sales revenue which is sufficient reward for the costs caused. Secondly, we should be looking at these cost structures and thinking, how can we improve performance? And one of the ways in which you can improve performance is, of course, to try to reduce costs. And we should be looking at this 50 to 80 here. And we should be looking at both the 50 and the 80 indeed, and saying, is there any way we could cut down the amount of material, or perhaps the quality of the material which we're using in the products, or can we make it slightly more efficiently, quite slightly quicker perhaps, so there's less direct labor involved. Those are all worth looking at. If you can cut out some of the material or reduce its quality without hurting the selling price you're going to get. But if you were to, say, substitute a synthetic material for a natural material, and people are paying you a good price because the product is made out of a natural material, then substituting in a man-made material is likely to hurt you in the long run. It's interesting here that nearly, the next substantial cost almost here is the setup cost, particularly in B. And I said, the place to find high cost savings is to go for the high costs. And here there's a huge difference here between the 35 and the 7. And anyone going down this 80, 35, 40 should, have their attention really drawn to this 35 as being quite a substantial cost. Whereas over here, the 7, we'd probably say to ourselves that's really quite a low cost compared to these other two. The chances of me being able to save a lot of cost to create a lot more profit is not great. And what we could suggest to perhaps the managers here is, could you not, instead of producing in batches of 100, if you were to produce really in batches of 200, that cost will be roughly halved, because you're getting twice the output for the same setup cost, and that could be really, quite useful in terms of improving performance. Finally, before we get on to the final ones here, what is activity-based management? Well, we would claim that activity-based costing is more accurate than and activity-based budgeting are going to be more accurate than the conventional treatment of costs. If you don't understand your costs properly, how can you budget properly? And if you don't know how to budget properly, you don't understand your costs properly, how on earth are you going to manage properly? So better planning and management should come out of activity-based costing and activity-based budgeting. There are two types, really, of activity-based management. First is operational efficiency improvement, basically increase cost effectiveness. And that's really what we looked at in this previous example. The operational activity-based management will be saying, is there any way I can get this very high cost down? It's a cost which is 5 times the cost there that's in product B, whereas every other cost is maybe double or something of that sort. So it directs your costs, or directs your attention at the costs which are maybe worth investigating. And then there is strategic activity-based management. We're always looking around to think, what other products could we develop and sell? Maybe should we withdraw some products and so on. And again, it's really saying, unless you understand your costs properly and you understand the profits properly, you're not going to be making good strategic and planning decisions. Finally, on this section, just 4 other little kind of developments to mention. I'll leave you to read most of these. First of all is the idea of value analysis. And really what you're doing in value analysis here is you examine a product and you look at its various features, and you think to yourself, or you try to find out, how much does the customer value these? Is the customer willing to pay for that particular piece of material or process which has been undertaken? So if you were producing components for aeroplanes, then the customers would value very highly anything you put into ensuring quality was very, very good. If you're producing luxury cars, then customers are likely to value very highly, let's say, the idea of having real leather in the seats. It's costing you, but customers value it. And if you were to substitute, say, in the car, plastic or fabric seats and coverings, it's going to save you quite a bit of money. But of course, the customer just sees the attractiveness of that product falling away, and will be reluctant to pay a good price for that. So what we're looking for here, is there any way we could, in a way, reduce the cost of something without hurting the product or without hurting the customer's impression of the product? A dedicated cell is basically, instead of in a production line where you have a product, going before a number of people in a kind of series there, everybody doing just a little exercise, a little bit of construction on that product. A dedicated cell is basically the product sits there, and you have a kind of team of people who are operating on it. Contingency theory simply says there is no right way to manage. And that's really all there is to say. In some organizations, they would require a fairly dictatorial way of managing. They would tell you to get on with it and not want any conversation about it. In other organizations, the best way to manage is maybe to have regular meetings where everyone can have some input. And finally, there's something which is called institutional theory. I don't think you need to worry about it too much. But you may have heard the phrase that people can become institutionalized. It's a phrase or a word which is used if people have, let's say, been in a hospital for a very long time, or perhaps been in prison for a very long time. They become institutionalized. In other words, their habits have been almost imposed on them, and these habits, from maybe spending years in a particular institution, these habits become the only habits which they feel comfortable with. And this can happen in organizations, the way they produce the budget. It's regarded as self-evidently the only way to produce a budget or to plan. And it's very hard for organizations to break out of the way that they're doing things, even if maybe they should think of more radical ways of managing, preparing budgets, dealing with customers, and so on. So institutional theory effectively says that almost that institutions or organizations can get in a rut, they can become trapped there. It's fine if the way they're behaving is still suitable for the environment. But if the environment changes, these organizations can be very reluctant to change, and many people within these organizations will put up great resistance to change, and it can become a very serious matter for the organization. So here are the questions you should have a look at on this section.